Are you a high-income earner who feels confident in your financial security? You might be surprised to find out how even the most financially savvy individuals can make mistakes that jeopardize their wealth. Whether you're firmly established in your career or just starting to see your earnings climb, this video is crucial for anyone looking to safeguard their financial future. Earning a high income might seem like a surefire buffer against financial worries, but it's precisely in this comfort that many pitfalls are hidden. From inadequate savings plans to risky investments, high earners often mismanage their wealth in ways that can jeopardize their long-term stability. In the next few minutes, we'll walk through these common mistakes, backed by expert insights and real-life examples, to help you avoid these financial traps. Stay tuned as we break down these critical missteps one by one, providing you with the knowledge to not just earn, but also to preserve and grow your wealth effectively. Mistake 1. Not having a financial plan. One of the most critical mistakes high-income earners make is not having a financial plan. This oversight can lead to significant financial disarray. Despite substantial earnings, a financial plan isn't merely about tracking where money comes from and where it goes. It's a comprehensive blueprint that guides you on how to manage your income to achieve both short and long-term goals. Without it, you're navigating the financial world without a map. Consider the case of Michael, a software developer whose annual earnings exceeded $250,000. Despite his high income, Michael lived paycheck to paycheck, spending impulsively on technology gadgets and luxury vacations. With no financial plan to guide his expenditures or savings, he found himself with minimal savings and no investments, vulnerable to any unexpected financial downturn. When Michael was unexpectedly laid off, the lack of a safety net dramatically impacted his lifestyle. He struggled to maintain his standard of living and realized too late the importance of a financial plan. It took this crisis for Michael to seek professional help to construct a financial strategy that included budgeting, savings, and investment planning, ensuring he would never be unprepared again. Mistake 2. Underestimating the importance of a budget. A common misconception among high-income earners is that a substantial salary negates the need for a budget. However, without a budget, even the wealthiest can face financial instability. Budgeting is crucial for managing expenses, saving for future goals, and preparing for unexpected financial challenges, regardless of one's income level. Budgeting allows individuals to track their spending habits, identify wasteful expenditures, and realign their financial strategies to maximize their financial growth. It ensures that money is being allocated efficiently across various categories, such as savings, investments, and discretionary spending, fostering a healthier financial lifestyle. Financial expert and author Elizabeth Warren famously advocated for the 50-30-20 rule in budgeting, which suggests that 50% of your income should go towards necessities, 30% towards wants, and 20% towards savings. Applying such frameworks can help high earners manage their finances more prudently and avoid the pitfalls of unchecked spending. For example, a high-earning corporate lawyer might make multiple six figures, but without a budget could easily find himself in debt due to lavish spending on luxury cars and high-end real estate. This scenario underscores the necessity of a budget to provide a clear view of financial activities and ensure long-term stability and growth. Mistake 3. Poor tax planning. Poor tax planning is a significant pitfall for high-income earners, often resulting in unnecessarily high tax liabilities. Effective tax optimization involves understanding the nuances of tax laws and leveraging them to minimize obligations legally. This requires proactive planning, including strategic investment choices, timing income recognition, and making use of deductions and credits available based on individual financial circumstances. For high earners, the complexity of tax scenarios can vary greatly, making it imperative to engage in year-round tax planning rather than scrambling at year's end or during tax season. This might include deferring income through retirement plans or other deferred compensation strategies, utilizing tax loss harvesting within investment portfolios, or taking advantage of tax-efficient investments like municipal bonds. Consider the case of Sarah, an executive earning in the upper bracket, who managed to reduce her taxable income significantly through strategic tax planning. By maximizing her contributions to retirement accounts and carefully planning the sale of her investments to offset gains with losses, Sarah saved tens of thousands of dollars in taxes annually. Additionally, by timing the receipt of bonuses and exercising stock options in years where her income was lower, she further optimized her tax scenario. Sarah's example illustrates how understanding and applying tax strategies can lead to substantial savings, highlighting the importance of sophisticated tax planning for high-income earners. This proactive approach not only ensures compliance but maximizes financial efficiency, turning what many view as a burden into a manageable and beneficial aspect of their financial portfolio. Mistake 4. Overlooking retirement savings. One detrimental mistake high-income earners often make is overlooking the importance of early retirement planning. The allure of immediate gratification can overshadow the necessity of preparing for the long-term future. But the benefits of starting retirement savings early cannot be overstated. The power of compound interest means that the earlier you start saving, the more time your money has to grow. For instance, if a person starts investing $10,000 annually at age 25 in a retirement account with an average annual return of 7%, they would accumulate over $1.7 million by age 65. However, if the same person starts at age 35, they would contribute the same annually, but would accumulate only about $734,000 by age 65 due to having 10 fewer years of compound growth. This scenario highlights the critical nature of early and consistent retirement contributions. Delaying even a few years can significantly reduce the total savings achievable by retirement. According to the National Institute on Retirement Security, about 2/3 of working millennials have nothing saved for retirement, underscoring a widespread lack of early planning. By prioritizing retirement planning from the start of one's career, high earners can ensure they're not just living well today, but are also securing their financial future. Mistake 5. Excessive lifestyle inflation. Lifestyle inflation occurs when an individual increases their spending as their income rises, often maintaining or worsening their financial stability despite higher earnings. This mistake can gradually lead an otherwise financially secure individual into a precarious financial state. Take the case of Thomas, a tech entrepreneur whose startup success rapidly boosted his income. As his earnings grew, so did his lifestyle. He upgraded to a luxury apartment, bought high-end vehicles, and frequented expensive restaurants. Despite his substantial income, Thomas saved little, assuming his financial growth would continue indefinitely. However, when market trends shifted and his startup's revenue declined, his extravagant fixed expenses quickly became unsustainable. Thomas faced severe financial difficulties that could have been mitigated with more prudent spending habits. Mistake 6. Inadequate insurance coverage. Inadequate insurance coverage is a critical oversight many high-income earners make, often underestimating the potential risks that could lead to substantial financial loss. Essential insurance types for high earners include life, disability, property, and liability insurance, each serving to protect against specific vulnerabilities. Consider the case of Emily, a successful real estate investor who believed her healthy savings were enough to forego comprehensive insurance. Unfortunately, when a major lawsuit hit one of her properties for safety violations, Emily faced immense legal fees and potential settlement costs. Lacking sufficient liability insurance, she was forced to liquidate some assets to cover the expenses, a financial blow that could have been mitigated with proper coverage. Emily's experience highlights the dangers of being underinsured. Adequate insurance acts as a safety net, safeguarding against unforeseen events that could otherwise severely impact one's financial well-being. High-income earners, in particular, should ensure their insurance coverage matches their lifestyle and assets to protect their financial future effectively. Mistake 7. Poor investment decisions. Poor investment decisions are frequently seen among high-income earners, particularly those who venture into high-risk areas without adequate knowledge or diversification. Common pitfalls include investing heavily in single stocks, speculative ventures, or high-stake businesses without considering the potential for loss. Such concentrated positions can lead to significant financial damage if the investments perform poorly. Financial experts often advise against putting all your eggs in one basket. Instead, they recommend a diversified portfolio that spreads risk across various asset classes and industries. For instance, John, a seasoned financial advisor, suggests that A well-diversified portfolio not only minimizes the risk of a catastrophic loss, but also positions you to capture returns from different sectors of the economy. Adhering to this strategy can prevent the common mistake of chasing high returns from risky investments and instead promote steady, long-term wealth accumulation. High-income earners should seek professional financial advice to craft investment strategies that align with their overall financial goals and risk tolerance. Mistake 8. Ignoring estate planning. Ignoring estate planning is a grievous oversight many high-income earners commit, often underestimating the chaos and disputes that can arise from not having a clear plan for their assets after death. Without an estate plan, the distribution of one's estate can become a legal battlefield, leading to potential family strife and significant financial waste in probate costs. Take the case of Robert, a successful entrepreneur without a will or any estate planning documents. Upon his unexpected death, his family was left to navigate a tangled legal process. The absence of clear directives led to prolonged legal disputes among his heirs, significantly diminishing the value of his estate due to legal fees and taxes that could have been minimized with proper planning. To avoid such consequences, it's crucial to establish a will. Consider setting up trusts and regularly update beneficiaries on all accounts. Mistake 9. Not seeking professional help. Not seeking professional help is a critical mistake many high-income earners make, assuming they can manage their finances solely based on their own knowledge. However, the complexities of wealth management often require expert guidance to navigate effectively. For example, Lisa, a highly successful software engineer, initially managed her investments independently. Despite her intelligence, she lacked specific financial expertise, leading to suboptimal investment choices and inefficient tax planning. Realizing her limitations, Lisa decided to consult a financial advisor. The advisor restructured her investment portfolio, improved her tax strategy, and set her up with a robust retirement plan. Within a few years, Lisa saw her investments yield higher returns, and her overall financial health improved significantly. Experts can provide invaluable insights, tailored strategies, and ongoing management that help maximize wealth and secure financial futures, making their services an essential investment for high-income earners. Remember, earning a high income doesn't automatically secure financial stability. It requires careful management and strategic planning. If you found this information helpful, please consider subscribing to our channel for more insightful financial guidance. Like, share, and comment below with your experiences or questions about managing high income effectively. Your engagement helps us grow and continue providing valuable content. Thank you for watching.